It's time to sell now. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, all hell breaks loose on Monday. I'm going to show you why you want to sell now before the panic hits, because this is our Sunday show, the show that makes you money, where we like to look at the technicals, momentum, and machine positioning each and every Sunday to help you make more money trading and investing. Now let's head over to Bloomberg, where we picked today's story up with the headline as buyback blackout adds extra layer of uncertainty for U.S. stocks. And this is the risk we're facing because we're heading into the worst 2-week period of the year. And this is a challenge because investors are along this market. We're seeing corporates about to head into the blackout window, and even worse, as you're about to see, the machines are looking to sell. And U.S. companies are now facing an embargo on repurchases. This started on Friday, and this into the run-up into third quarter's earnings season. Investors say the restriction is making the outlook for equities even more clouded at a time when the Federal Reserve is nearing its first interest rate cut in 4 years, and uncertainty about U.S. elections and the economy abounds. And the bigger issue here is the Fed, because we're headed into the blackout window now. It started on Friday. It's only going to accelerate as more companies black out each and every day. The challenge now is, can the Fed give the market confidence that they're achieving a soft landing, or will the Fed spook the market into a massive sell-off? And markets are emotionally scarred from the first week in August. With buybacks in a blackout period, it puts even more emphasis on the Fed to come through with a rate cut, because investors falsely believe that rate cuts somehow are bullish for stocks. It's all about economic fundamentals, and what we're going to find out in the third quarter is things didn't get better, they got worse. And yet Morgan Stanley says the market is in a short-term overbought scenario, which we totally agree with. And we look at the charts we'll show you as we're entering the seasonally treacherous time of the year. It's not just treacherous, it's the absolute worst 2-week period in the history of the markets. It's starting on Monday. There was a case for you to get out. This is it, as the market is now expecting a perfect landing by the Fed. But be patient, because their track record of achieving such things is absolutely 0%. The Fed's never done this in history, and yet investors each and every time line up. They buy stocks in a big way because they believe the Fed can pull off the impossible, and they never do. But now let's turn to Goldman, who has been warning that we're entering the worst seasonal period for stocks as we head into the second half of September. We're now right here where I have this circled as we look back in history of the composite period going back to 1928. The data is very conclusive. It is the worst 2-week period, and you want to get out. And Goldman notes that again, and Goldman again confirms the second half of September. This is the worst 2-week trading period of the year for the S&P 500. And how bad is it? Well, just going back the last 4 Septembers, you're looking at dropping 5%, and that's in a good case. The NASDAQ a little over 5%. If the Fed's signal is taken as bad news for the economy, it could sell off even more, particularly if the machines start to sell, because we enter September with local systematic length fully recovered and corporates heading to the blackout window as pension funds quarter in supply and some mutual fund year-end important dynamics that Goldman knows. Because what do we see from pension funds? They're likely to be selling stocks here going into the end of the year because they're overweight equities. We see mutual funds need to do some repositioning. All of these things could lead to a massive sell-off in stocks over the next 2 weeks, and the CTAs could be ones behind them, because we go back a couple of weeks, we're now entering the second half of this 1-month CTA exposure. We see in a flat tape they're net sellers. In an up tape, they were buyers, but look at this. If we see a down tape over the next 2 weeks, you could see $195 billion in global equities with $65.5 billion out of U.S. equities, all coming by the end of the month. This could send stocks sliding in a massive way. And one of the issues here is corporates are big buyers. They've been the largest buyer of the equity market, and we expect their demand to drop by 35% during the close window. Now, the buyback bid has been very, very strong, but a wane into September 13th, when 50% of the corporates now entering blackout, and chaos set to begin Monday, because this means we're seeing that $6.62 billion in passive demand from this group get cut in half, and it's only going to get worse. But let's take a look at our screens here. We're talking about a market being overbought, a market being stretched. Let's take a look at the S&P 500 because we know momentum is positive. And how do we know that? Because the relative strength indicator, this is a technical indicator. It's above 40. It's at 59. That means momentum is positive. The moving average convergence, divergence, or MACD, this has a positive cross. This also denotes that momentum moving to the upside. Now, if you have trouble reading these or you have trouble trading these, well, we run a proprietary overlay on a bunch of technical signals. We call that report Momentum Timer Pro. It's got 3 consecutive daily buy signals. Now, what's unique is we look at momentum over a 1, 3, and 6 month period, and we look for shifts when momentum is to the downside and then shifts to the upside. We flag that on our reports so our subscribers can take advantage of a swing and momentum with a great deal of confidence. Now, we're looking to back test that here as we speak. Our programmers are working on that, but you'll note we have no position in the S&P 500, and we've told our subscribers that any equity positions we've recommended, which we have just a couple, that we need to tighten up the stop losses heading into the blackout window because the risk here is high. Now, we talk about machine positioning. We run a report called CTA Timer Pro where we mimic the fast and the slow algorithms. You can see the machines here should be backing off their very long positions. Right now, we show a 35% exposure to the upside. Now, if you want to take advantage of these reports, it's very simple. Check out the links in the description below because you get the daily reports. We give you all the tradable signals. I go through each trade and give you my opinion on them. We give you stop loss levels to protect your downside risk. We track them for you. We give you a weekly update each Saturday on the stop loss levels. Here's the best part. Not only is it fully duplicatable, but you get a 30-day free trial. This is amazing because you can duplicate each and every trade we do. Links in the description below. Don't get caught off guard by this market downturn. Now, let's check out the price chart here on the S&P 500 because it's starting to look like a triple top. You see the market set an all-time high here. It pulled back. Everybody came in and bought the dip on that yen carry trade blow up and got right near the all-time high. And what happened? Well, sellers came in and then buyers once again said, no, we got to take this higher. The Fed's going to cut rates. But what we're seeing now is evidence of a potential triple top. We know the momentum here still has somewhat to move to the upside. Of course, one thing we've talked about is the potential downside risk. So let's look at the weekly chart here. In fact, let's zoom in a little bit closer to that. Let's go to the 10-year chart. What do we see? On a weekly basis, the relative strength index and the MACD are both slowing down despite facing this triple top scenario. The risk we face here is during this blackout window, we could see stocks move to the downside. If you start to see those weekly technical signals break down, you're going to see a much larger move down in the market. And there's some evidence then as we turn over to the tech stocks. Now, momentum is positive here. It only mattered for 2 days, according to our reports. We see the relative strength indicator took off. It's at 56. MACD's got the positive cross. Our Momentum Timer Pro picked up that change in momentum over the last week, but we don't have a position on this either. Now, we do have a position in tech stocks, but it's not on QQQ, and we told our subscribers, you got to tighten up your stop loss levels here. Now, it did hit our upside target, and we revised that now higher, but our downside target really hasn't changed much. But look at the machine positioning, still here around 35% long exposure. We know from Goldman and Nomura and other companies, they're maxed out almost to the long side. You see a sell-off in equities. You're going to see the machines start to dump here. But let's take a look at QQQ. And what do we see? A similar scenario here. On the weekly, you'll note that the RSI and the MACD, they hit overbought territory several times and are now rolling over to the downside. But what really concerns me is on the daily chart, what do you see? A series of lower highs. So you have an all-time high, a pullback, a lower high. And mind you, these are the companies that are buying back massive amounts of their stock. You see a pullback, and right now it's still below that second high here. We think this is rolling over. If it does, watch out to the downside. We're not talking about a bull market anymore. We're talking about the early stages of a bear market. Now let's talk about the Russell 2000 because momentum here is positive. RSI is at 56. MACD saying, well, maybe not with a negative cross here. because Momentum Time Pro's got one consecutive daily buy signal. That's nothing to write home about. It did hit our upside target. We did revise that to the upside. Again, we're still not sure it's going to hit that target. 202 is going to look more convincing to me during the blackout window. But let's head over and check out IWM, because what do we see? The same thing we saw in the NASDAQ 100, a high, a pullback, a lower high, a pullback, and right now what appears to be a lower high. You see this 202.21? This is a 6-month volume profile. This is a 200-day moving average in tan. I believe this rolls over. If it breaks out below that, we zoom out to the 1-year chart, you see this lower band here, the next likely destination. But the reality is, the last time it was here, it didn't really hardly hold support. You could be down here in the 160 level before you know it. Particularly, again, seasonal factors here. It's not just the next 2 weeks, but heading in an election, stocks usually don't perform all that well. So keep that in mind. Now, let's take a look at, of course, the banking sector, because rate cuts should be bullish for the banks, but they're not at all. Still momentum here being positive with a relative strength index at 53. MACD's got a negative cross, potentially indicating we're seeing a move to the downside. Momentum Timer Pro still got one daily buy signal, but I wouldn't hold on to that too long, because we did hit our downside target only briefly, and we are leaving our upside target right where it was. But again, you note that we're leading the machine position here because we run a historical overlay, and that is a huge difference maker. We tell the machines where they ought to be, and eventually they catch up. That gives you the advantage in trading against the machines and making money. But what do we see here? A high, a lower high, a potential lower high coming in here. This means roll over and head to the downside. The first stop here is this brief supply zone, and then the downside move to the 200-day moving average. Of course, we know if it breaks 200-day moving average, is often considered very bearish for the market. But let's take a look at emerging markets here, because we see momentum being negative. Now, this is one that didn't flip. We saw a lot of flipping of momentum on Friday on the daily charts. But how about this? Relative strength index at 52. MACD's got a negative cross. Momentum Time Pro, 9 consecutive daily sell signals here. So we're going to see this thing enter a 1-month window of negative momentum before long. But let's take a look at the chart for EEM here and see what we can find, because it suggests momentum. It did get a little to the downside and then popped up, but it's still the trend on the daily chart as momentum is heading lower. But if you're looking for a topping pattern, here you have a left shoulder, here you have a head, you have a right shoulder. Your neckline is going to be somewhere right here around this 41.81 level, right where it holds support. If it breaks that 41.81 level, look for people stop loss to trigger. That will send some downside movement. We're looking at 39.50 here at some point, a break again of that 200-day moving average. If you're wondering what that white shaded zone is, that's called Steve's zone of doom. You break that, you're into all-out financial crisis. Now let's talk about the bond market. Because what we know from Nomura is that their machines are max long U.S. Treasuries. Of course, there are sell signals coming up, but we're still not there. But if we see 10-year Treasuries get below 111.79, look for some profit taking on the machines. But let's take a look at our screens here, because people said there was no way we'd ever make money on this TLT trade. We went back in March, had to buy it open, and we just didn't make any money. We didn't put a stop loss level on. So something I want to encourage you is to trade with stop loss levels. But if you don't, or you forget, and you find yourself getting upside down, just use the reports to dollar cost average in. And check this out. We went from a loss to a 6.82% gain, not counting dividends. Cost basis at 94. Friday's closing at 141. Upside target, we didn't quite get there. We're going to see this is going to be very sensitive to the Fed as announcement on Wednesday. But here we see momentum is still strong. The daily count on Momentum Time Pro still looks good, but we see momentum is maxed out. I do believe there's going to be a pullback in bonds at some point. That may all depend on what the Fed has to say on Wednesday. Of course, we'll be covering that, as you know. Though here we see resistance is right at where it's sitting at right now. This is a level that was previously support. Now it's resistance. Would not surprise me, and all of sellers try to push back here. This would create an opportunity, if you're not long the bond market, to look to add positions on a pullback here. Perhaps the Fed will spook the markets and send this rallying higher. You'll find out for sure this next week. For the moment, this looks intact. This isn't something I'd look to add to, but on a pullback, I would look to add to that in a big way. Now, gold is breaking out. Is rate cuts bullish for gold? Well, the problem is everything is bullish for gold. And right now, this is breaking out to new all-time highs. You'll note we're not chasing this higher because why buy high when you can buy something low? We'll show you some other opportunities. Here again, you see 26 consecutive daily buy signals. Momentum nearly maxed out across all positionings. We see, of course, machine positioning, long gold. There is just a lot of risk when you're buying at the top and hoping to go higher. But let's talk about something that did follow through here. That is GDX. This is Van Eck Gold Miners. Momentum turned positive over the last 2 days, and price just took off. The relative strength index is 63. MACD's got that positive cross. Momentum Timer Pro, it should say 2 daily buy signals. Well, a little typo there on my behalf. Upside target, we tagged that and we revised it higher. I didn't think that was going to happen. You might remember I said I think the move for gold is to the downside and for the miners here, but nope, people took it higher, and you see this thing just stair-stepping higher. Look at the difference between this and the NASDAQ. You see a high, a higher high, a higher high, and now even a higher high than that. We go out to the 5-year chart. Your upside target is right here in that low $41 range. You see the prior top here. There is a good chance we're going to see this get there. Let's take a look at the technical signals because they are rallying higher, and people are going to chase gold and miners to the upside here. We'll see if the Fed changes any of that momentum. But talk about something that we have been flagging to our clients on our reports. They said, watch out. Do not touch the dollar here. We don't like the dollar going into the Fed rate cut announcement. Here we can see momentum did turn. It did show up on our reports. We went from a short machine positioning to a long position. We saw a momentum shift, and yet we still told our subscribers, don't touch this thing. RSI's at 44. MACD's got a negative cross. The fact that we see momentum and machine positioning turn is not the issue, because when we look at UUP, what do you see? Something that doesn't look very good. The 200-day moving average is looking at resistance. We did tell people, if you're going to trade this, there's your upside target. But look at this. It runs right into that 6-month volume profile and gets rejected once, twice, 3 times. And this time, we think it's headed down. How far could this dollar go? Well, wouldn't surprise me in the short term if we get down here to the high $27 range. But look out below. You're looking at around the high 26s as a much broader target. You see a topping pattern here. It's very evident. You see a left shoulder, head, right shoulder. It broke the neckline right there, plunged down. Now coming back up to the neckline to find resistance, and it's doing that, meaning the case for the dollar is lower, and that means the case for commodities is higher. Now, one thing that's cool about our reports is we simply trade machine positioning and the technicals, but this is amazing because all of a sudden we see a bunch of news articles coming out on the commodity market. Those of your subscribers know these are some of our biggest trades right now. Let's talk about soybeans because the news is coming out very bullish for this. We had a buy it open on October 27th. This trade's up 2.22%. And how did we do it? We just followed our reports. These are live stop loss levels. This is exactly what our subscribers see. 2171 is their stop loss. Machine positioning turned, momentum turned off deep short positions. We told people there's going to be huge opportunity here, and we think it's only going to get better. Let's take a look at soybeans because this is a big opportunity. That and other commodities, especially on a weaker dollar. Now, right now, it's running into resistance. It's 50-day moving average. That's that green line there. Not a surprise. Look for a bit of a pullback before this thing takes off again, and that's what you get. The early signs of a bottoming pattern. If you're not in soybeans, you still have a good chance to get in here. You see momentum rising. You see the volume here is holding this zone here. So if it gets a bit of a pullback, if it pulls down here, it's okay. And we might get stopped out of this if that happens, but there'll be another opportunity. But nevertheless, we see a bunch of upside potential here on a weaker dollar that could send soybeans up into this $24 range. You zoom out here over a 2-year chart, and you clearly see the last level of support that broke was right here around 24.50. You see upside target to there. This is looking like a fantastic opportunity. And a lot of people, they only look at the stock market. They don't realize there's plenty of opportunity elsewhere in the market. Of course, we give you all the insight on that. Check out those links in the description below. Start making money trading and investing like you never have before. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.